Hey, dancing friends, this is Paul, Dr. Nacho. You're about to watch Understanding a P&L with Bob Septak, accountant and president of United Dental Brokers of America, a transitions company that I work with, helping dentists buy and sell practices. This information is super important when you go to buy a practice and sell a practice, and they do not teach it to you in dental school. So check out this awesome presentation, and I'm going to jump on at the end with a special offer for you. To my friend and mentor, Bob Septak. Thanks for being here, Bob. Thanks, Paul. Appreciate it. Sure.
Hello, everyone. I appreciate the opportunity to do this. And the premise for me is that I see a lot of tax returns on a daily basis. And in my interaction with dentists, what I see is they get a tax return, not even at the end of the year, maybe in March, April, May, whatever. And they might not even understand what it is. So that's kind of my premise for this, and the buyers as well, as far as understanding these financials. So a little background on myself. I have an MBA from the University of Pittsburgh, been an accountant for years, have done business valuations for years. Obviously the company that I own, United Dental Brokers of America. And the last thing on there is a good story that Paul's probably heard from before, but lead singer with the Temptations. And so I was taking a class at University of Pittsburgh, and this one lady had tickets for the Temptations, asked me if I wanted to go. I said, I'd love to. We go to the concert. We're in the second row, center section. And all of a sudden, the Temptations start pulling people on stage, and they pulled me on stage with 6 other people. I'm just bebopping to the music. I'm thinking this is fine. And then all of a sudden, they hand the mic to one of the 7 people, and he starts singing the song, My Girl. And I'm thinking, hey, that's fine. I'm just back here. All of a sudden, that person gets off the stage. They hand the mic to the next person of the 7. And I'm getting an uneasy feeling. And one of the Temptations says to me, okay, you're next. And I says, oh no, I'm not next. I can't sing and I don't know the words. He says, no, you're next. So that person gets off the stage. They put me front and center of the Syria Mosque in Pittsburgh, hand me the mic. And I said to the guy, I'm telling you, I can't sing and I don't know the words. He says, no, here you go. So he starts mouthing the words to me. I sing it. I'm sure I'm horrible. I get off the stage. The next day in the newspaper, there's an article about the concert. It said 1 young man, 1 young woman were very good. As for the other 5, let's just say they had fun. So I know I was one of the other 5, but that's my one claim to fame. Anyway, so let's get back to accounting and financial analysis. So again, what we're going to try and do here is we're going to start slow and just try and have a basic understanding of financial statements, accounting, balance sheets, income statements, and the terminology. So with that being said, here we go. The one thing I do want to say, though, is that whether you're a buyer or even if you're already a dentist with your own practice, you really want to have an accountant that specializes in dental practices so that when you get your financials, they can explain it to you, and they understand the industry, they understand the numbers. So, and as a buyer, same thing. If you're going to buy, you want to have an accountant working with you that understands these numbers. So there's 5 account types in accounting. There's revenue, expenses, assets, liabilities, and equity. So again, we're going slow. Revenue or income is the money received from the sale of products or services. Expense is the money spent on goods or services. Assets are the things that you own. And there's 2 major types of assets, tangible and intangible. Tangible assets, obviously, are things that you can touch, cash, furniture, fixtures, equipment. Intangible assets are things that you can't touch, goodwill, copyrights, patents. What's the most valuable asset in a dental practice? So if I ask this question to a class, I'd get various answers, but It's not the equipment, certainly. It's the goodwill. And how much of the value of your practice? Typically about 70 to 75% of the value of your practice is the goodwill. Liabilities are things that you owe, obviously. There are short-term liabilities and long-term liabilities. So when you're looking at this balance sheet that we'll show you shortly, there's short-term, which are items that are going to be paid in under a year, and long-term are items that will be paid in longer than a year. Example of short-term liabilities, you have accounts payable, notes payable, payroll taxes. Some examples of a long-term, or you're going to be your bank loan if you had a loan when you bought your practice. That's going to have two different pieces. So have a short-term piece and a long-term piece. And equity is the difference between your assets and your liabilities. Difference between what you own and what you owe is your equity. So there's two different types of financial statements that keep track of those 5 accounts that we talked about. There's a balance sheet and there's an income statement. And a balance sheet, again, as we said, is everything in the practice that we own and owe, and the difference being your equity. And hopefully that's positive. And we actually have an example where that's not coming up. Income statement is your profit and loss. There's a schedule to recapture revenue and expenses, with difference being your profit and hopefully not a loss. And a tax return, there's 3 main types. Sole proprietor, which is a Schedule C, which is really basically your P&L. There's a partnership return, 1065, which is a P&L and a balance sheet, and a corporate return, an 1120 or 1120S, which is basically your P&L and a balance sheet. And this on the screen here is just a basic balance sheet. So as we go through it, on the left side up top, you've got your current assets, cash, savings. Underneath that, you have your non-current assets, auto, land, building. And then underneath is your accumulated depreciation. So as you depreciate these items, it'll accumulate in that little account there. Underneath it, you have intangible assets, so you have your goodwill, and then your amortization, which will accumulate your amortization expense each year for that asset. And then the bottom is the total assets. On the right up top, you have your current liabilities. Underneath that, you have your long-term liabilities. Again, like your mortgage on your building, or the long-term portion of the note when you bought your practice. And then the difference down below is your owner's equity. Now, if you note on a balance sheet, it balances. The total assets equals the total liabilities and the owner's equity. And that's, probably where they got the name, because it does balance. It has to balance. And here's an example of a basic income statement, or P&L, or profit and loss, which has your revenue, in our case, we call it collections, and then your expenses, and the difference being your net income or the profit. And this is just a basic look of a tax return, which really is no different than your profit and loss, except that it's in a tax return format. This is an example of an 1120S. So the balance sheet is going to be the less exciting of the items that we're going to talk about today, between that and the profit and loss. It's static. It's a picture of one day in time. So in this case, this balance sheet, it's telling you everything about that practice on December 31st, 2018. So it's a picture of that on that specific date and time. If you look at it December 30th or January 1st, the numbers will be different. So on this particular day, again, you've got, the assets, the current ones, the non-current, intangibles, total assets, and on the right side, your liabilities, long-term liabilities, and then your owner's equity. And again, at the bottom, your liabilities and owner's equity equals your total assets. The thing that the banks like to see when they analyze a balance sheet is they want to see 2-to-1 ratio or better. So for current assets to your current liabilities, they want to see that you have $2 of current assets to cover $1 of current liability. In this 2-page comparison here, the one on the right, you'll notice, has a lot more debt than on the one on the left. And also you'll see in the red, there's negative retained earnings. And not only is there negative retained earnings, there's negative owner's equity. And you say, well, how can that be? How can you have negative net worth? Well, if you look, your total liabilities are more than your total assets. So you owe more than you own. So your owner's equity, remember we said your owner's equity is the difference between your assets and your liabilities. In this case, it's negative because you owe more than you own. So we're slowly going to get to more exciting things, which is the income statement. And as we talk about the income statement, the question always is, what's the most important thing on there? And I know a lot of dentists want to talk about what their collections are. But as we look at it, really the most important thing is the bottom line, not the top line. Because that's what we want to see is how much you're actually making after you pay your expenses. In this case, we have $500,000 of collections and then 200 and some thousand of expenses. And we're saying you have $231,000 of profit. The key here is identifying what that true profit is. So even though we look at that one that we just looked at, it says it's 231,000, maybe that's the real true profit and maybe it's not. So one thing that you may hear about is something that's called recasting or normalizing the financials. And that's really a method where we go in and adjust the financial statements for a number of things. You've got non-cash items, you have one-time expenses, you have unusual items or discretionary items that we need to adjust for to try and come up with a true profitability or true cash flow of that practice. So again, you're going to have non-cash items, which are amortization, depreciation, discretionary items that aren't necessary in the course of the business normally. You have salary, benefits, and payroll taxes for the owner or his family. You might have excess or too little expenses or none at all. An example of, no rent being paid or no wages may be paid to the family member. And then you might have an associate salary that we might want to add back if the buyer is able to handle the purchase of that practice and the work. In that case, we can add that back, and we'll see an example of that here in a little bit. Cash versus non-cash expenses. So in this example that we have here, this basic income statement, everything on here is a cash expense. There's no depreciation, there's no amortization. So in this example, if we started with zero in the bank, at the end of the year, this business would have contributed $231,000 into the bank by operating this dental practice. So again, these non-cash expenses, depreciation, amortization, are items that you didn't actually pay cash for necessarily, but you're able to deduct it as if it was a cash expense. And it's really predicated on, what the IRS is telling us what to do. So the two examples again are depreciation and amortization. And depreciation is an expense of a tangible asset, and amortization is an expense of an intangible asset. And on the tangible asset, the IRS has us where we're going to expense that item. So we're going to depreciate it on a period between 3 and 39 years, depending on the asset type. And the idea is that that asset isn't just going to last 1 year, it's going to last for a number of years. And we want to try and spread that expense over the useful life of that asset. So if it's a 3-year estimated useful life, we'll try and expense that asset over 3 years. If it's 39 years, then we try and expense it over 39 years. So we're gonna have an example here where we say we bought a new CT scanner for $150,000 with an estimated useful life of 10 years. So in this case, we're gonna depreciate it, expense it, $15,000 a year for 10 years so that the expense matches the estimated useful life of that CT scanner. So the reason we want to do that, because if we don't do that, this is what would happen. You would have an income statement or P&L that shows equipment expense $150,000 in 1 year, which really is not showing us a true picture of what that practice did in this particular year. So what we get instead is this income statement where we have $15,000 of depreciation, and the net income is $216,000 versus the $81,000 we would have had if we expensed that piece of equipment all in 1 year. Now again, from a cash flow perspective, we didn't necessarily spend $15,000 on that asset. So as far as cash coming into the bank, it wasn't the $216,000 that we would have put into the bank operating this practice. It still would have been the $231,000 because the $15,000 wasn't a cash expense. And going to the amortization, that's expensing an intangible asset, and we're going to amortize that over 15 years, which is what the IRS tells us we're supposed to do with it. So let's say we purchase some patient charts for $75,000. We're going to amortize that goodwill, $5,000 a year for 15 years. So here's an example where we show that amortization of that goodwill, $5,000 amortization, and the net income or the profit is $226,000. And again, since we didn't spend $5,000 cash that particular year, if we add that back, we really still ended up with $231,000 of cash flow during that year that the practice kicked off. And here's just an example with both of those non-cash items, amortization, depreciation, $20,000 between it. Again, they're non-cash items. That bottom line is impacted by that. If we want to know how much cash we earned during the year from operations, it really wasn't $211,000. It was still $231,000. We'd add back that $20,000. Some other items we're going to look at when we're reading an income statement here. We look at this and we see this owner's salary, officer's compensation, and we see how that impacts the bottom line. And we see there's $150,000 being paid, which reduces the net income. So in this instance, if this was your practice or a practice that you were looking at buying, the net profit on there really isn't $81,000, it's $231,000, because you need to add back that officer's compensation that was deducted in order to get to the $81,000. And I know this might be easy for some folks, so hopefully we're not going too slow, but we're trying to really, teach the basics to some people that may not understand this. Here's an example when you're looking at a profit and loss or income statement where you have excess rent. And how does excess rent come about? Well, you have a owner who owns the practice, who also owns the building that the practice is in. And in talking to his accountant, possibly, they decided we're going to charge $80,000 a year rent to ourselves for that building. So the dental practice is paying $80,000 for rent for the building owner, which is the dentist. Now, in this case, that sounds like a lot of money. In this case, it actually is, because the real fair market value for that space is really $30,000. So given that's the case, you look at this, there's $80,000 coming off, but the real fair market value for that rent for that building is really about $30,000. So there's $50,000 being expensed that is impacting that bottom line. So if you really want to know what that real bottom line should be, or if you're a buyer and you're looking to buy this practice, you're not going to pay $80,000 in rent. You're going to pay fair market value to rent that building, which would be $30,000. So if you were looking at this, the real profit isn't $181 if you're the buyer. You're going to add back $50,000 so that only $30,000 was deducted. So again, your true profit on this is $231,000. So that's an example of excess rent. The next one we're going to have is no rent. So similar in that the dentist owns the practice, obviously. He owns the building, but he's not paying himself rent. Both of these scenarios we see on a regular basis where there's, well, there could be fair market value rent paid, there could be excess. In this case, there's no rent being paid. So that bottom line there is too high because there was no rent expense being subtracted as one of the expenses during the year. So in this case, if we're saying the fair market value in this building was $30,000, we would subtract out $30,000 and we get back to $231,000 as being the true profit of this particular practice, because we're not seeing rent. We need to adjust to see what it would really be. So again, if we're the buyer of this practice, your profit wouldn't be $261 because you're going to have to pay that owner rent. You subtract out the rent, and then your profit's going to be $231,000. Excuse me a second while I take a drink. Thank you.
You can take a break. You can mix it up now that you can take a break from the video for a minute. You can just use your clicker there.
Okay, back to clicker.
Sure.
Okay, so this example here is where we have no pay for the owner's wife. So the wife in our example works at the practice. Let's say she's the office manager and she gets paid, let's say $45,000, but the practice isn't paying her. Why is the practice not paying her? Well, just because the practice isn't paying her. You'd have to ask the dentist why he's not paying his wife. So in this example, well, how do we know that? Because we're asking the question. That's how we find that out. So in this example, we found out through asking the question. The wife does work there. She works full time. She's not getting paid. We estimated the fair market value for his wife would be $45,000. To come up with a true cash flow on this particular practice, we would need to subtract $45,000 from the bottom line, because if you, the buyer, are going to buy this particular practice, it's going to cost you $45,000 more than what this is showing to run this practice. Or alternatively, even if you're the owner of this practice and you're looking to see, is this my true profit? It's not your true profit because you have an employee you're not paying anything for, right? So you artificially made $231,000 in this example because you didn't pay your wife. Okay.
Sometimes you get this. Once it goes for a while, I'll show you. There you go. So this one.
Okay.
Perfect.
So this next one is where I hear a lot I say a lot, but a couple times a year from a dentist that tells me my practice has 50% overhead, meaning that he has 50% profit. And when I hear that, I already know what the answer is going to be when I analyze his tax returns. It's going to be because he owns the building and he's not paying himself rent, and he's not paying his wife who works at the practice. So again, when we're looking at this, you want to make sure that you have your dental focused accountant working with you on this.
Keep doing this.
That's okay. Yeah, no, we're good. This next slide is an example of some possible add backs. It's not all inclusive, but it's just, let's say it's my short checklist as I'm looking at a set of tax returns on things I might need to add or subtract back to that particular set of tax returns. Owner's salary, as we saw before, you can have a practice can either pay itself, the owner, or he cannot pay himself. So he can just take a draw, in which case you're not going to see an expense. So if something like that's happening, we're going to need to subtract out the salary. And in the next item there, we have family members, and you could have an add back or a subtraction depending on whether they're getting paid, not getting paid, or getting paid too much or too little. So in our example with the wife working there, let's say that wife where the $45,000 was fair market value. What if she was getting paid $20,000? So in that case, we would need to subtract $25,000, right? What if she was being paid $80,000 for fair market value of $45,000? In that case, we're going to need to add back some items to the bottom line to get back to the true profit. Rent, you're going to have an add back or subtraction depending whether there is rent or not being rent. Non-cash expenses, as we show, is going to be an add back. Employee benefits is going to be an add back. Expense is not necessarily a normal operation of a practice. So we have auto, travel, meals, and entertainment. We add that back because as a dentist, you're allowed to deduct it, but you really don't have to travel to see your patients. So we consider that an add back. Associate salary, that may be an add back possibly. So let's say you're looking at buying a practice and there was an associate being paid. If you can buy that practice and do that associate's work in addition to the owner's work, that can be an item you can add back to the bottom line to see what your starting point would be cash flow wise. If there's personal items being run through the business, which we see a lot, we would add back for that. One-time item, like let's say you have an attorney's fee for $50,000 in 1 year. That's not something that's going to happen every year. We would make adjustment for that. This next slide, how can I be making all this money but have no money in the bank? So we've got a couple examples. So in this first example, we have someone that's looking to buy a practice and he's making $165,000. And he's looking at a practice that's making $199,000. And he says, hey, this is great. I'm going to get a raise, right? And here's this profit and loss or income statement or even tax return that the buyer was looking at. $199,000, I'm going to get a raise because I'm making $165,000. The problem is he's actually taking a pay cut. And why is he taking a pay cut? Because he forgot to factor in he's got a loan he's got to pay. Then that's not shown on that profit and loss that he was looking at. So his 199 less the $65,000 a year loan to the bank, he's now making 134 in his pocket, as opposed to the 165 he was making before he bought the practice. So he's actually taking a $31,000 a year pay cut. Now, that seems like it's common sense, but it's something that I see where someone's forgetting to factor in the loan before they calculate how much it's going to be in their pocket at the end of the year. And this is just showing the math. 199,000 less his loan payments, 134,000 as opposed to what he was making. In the second example, we've got similar comment. Owner feels like he's not making enough money. And as we look at this income statement or profit and loss, one thing that jumps out to me is the interest expense. There's $50,000 of interest expense. When I see a number that high, that tells me there's a lot of debt. If you spend $50,000 of interest expense in 1 year. So what happens is on an income statement or profit and loss, you don't see your full loan. You only see the interest part of the loan. The other part of the loan that you're paying goes to reduce the balance sheet liability. I know it's a little bit confusing, but I'll say it again. When you pay your loan, you don't see all of that on your income statement or profit and loss, only part of it. Only the interest portion do you see on the income statement or profit and loss. The other part of it goes on the balance sheet and it's reducing your liability. So the owner who looks at this profit and loss sees 141, but it's actually worse than that. So not only was he paying $50,000 in interest expense, there was more cash coming out of his pocket to pay the principal portion. As you see over here, you see the debt that the owner had. And not only was there $50,000 of interest expense, there was $50,000 of principal. So he was paying $100,000 in loans. He was about midway through, because normally you're paying a lot of interest up front. He was about midway through, so about half was interest, half was principal. So in reality, he was spending $50,000 he wasn't seeing on the income statement because it was reducing his liability on the balance sheet. So again, I keep saying this over and over. Two keys to running successful practice is you want to hire an accountant that's dental focused, and then make sure you receive financials on a regular basis, and I would say monthly basis. So what happens again is dentists are getting a tax return, and that's all they get at the end of the year. And sometimes they don't get that till March, April, and if on an extension, even later in the year. So how can you make good decisions on your business when you're getting a tax return 15 months after the year started? You can't. So you really want to get financial statements on a monthly basis. And I would say in my experience, maybe only 10 to 20% of dentists are getting financial statements on a monthly basis. Most of the dentists that I see are just getting a tax return at the end of the year, which is not enough to make a good financial decision as you're moving forward. So in the past couple of slides, we've been looking at balance sheets, profit and loss, income statement. So we're going to talk about the tax return. The tax return really is no different than the profit and loss we're looking at. It just looks a little bit differently. And we just talked about how often the dentists get their tax return. So in this example of a tax return, this is 1120S, which is a corporate return. You've got your revenue, you've got your expenses, and again, it's no different than your profit and loss or income statement. It's just on how the IRS wants that reported to them. and how it looks on the form that you report to them. So what's that tax return really telling me? So on this one, we've got $56,000. So if this was a dentist receiving this and he was the owner and he's looking at that, is that good or bad? I'm thinking he's probably thinking that's not good, right? But if no one's explaining it to him, he has to sit and analyze this himself. One of the first things that I would point out to him is the compensation. There's officer's compensation. So to get to the 56,000, just as like we were showing you on the profit and loss slides, that officer's compensation has already been deducted. So he made more than 56,000 because he also was paid a salary during the year. So he made the salary that he earned and was paid, and he also earned the profit of the practice after he was paid. So again, if this was from your accountant, would you be happy or not? In this example, we've got in this slide, and again, from a tax return, it's really hard to tell. That's really why you want your accountant to decipher this for you. But in this case here, we had auto expense that was being run through the business, which is fine, but it's a discretionary item. You have health insurance that was being paid on the owner's behalf. You had profit sharing plan that was being paid on the owner's behalf. You had, in this case, excess rent. So the owner owned the building, was paying himself over fair market value for the building. That was impacting the bottom line too much. And you also had, again, officer's compensation and his payroll taxes that were being expensed, that was reducing the bottom line. And then you have travel, meals, and entertainment that are discretionary, that were also reducing the bottom line. So when we add back all those items, this tax return that was showing $6,000 of profit is really $215,000 is what really kicked off in true profit. So this next example, very similar, $50-some thousand on this tax return. And I put this on a spreadsheet so you could see all of the expenses. And then we highlighted in red the items that we thought we needed to add back here to the bottom line. In this case, we had auto expense, which was discretionary. We come back and we have, in this case, amortization, depreciation, which are non-cash expenses. So we didn't spend money during that year. So we're going to add that back. A little bit in gifts. You have interest expense, and why we're going to add that back in this example, because we're going to assume that you are a buyer looking at this tax return in this instance right here. And even though you as the buyer will have a loan and will have interest expense, you won't have this owner's interest expense. You won't have his loan. So we're going to add that back because that $4,600 is not something that you're going to have. The owner of this practice had pension profit sharing 401k paid on his behalf. We're going to add that back. Officer's compensation and payroll tax on that, we're going to add back. And in this instance, the owner was paying an associate. But this practice was really on a 4-day-a-week practice, and the buyer of this practice can do the work of not only the owner, but also the associate. So in this case, we're going to add back that associate's salary, the associate's payroll taxes, because in this case, the buyer can come in and do all the work of the owner and the associate, and that bottom line that we're going to come up to in the next slide is going to come to the buyer, and it's going to be a lot bigger number than this $50-some thousand we're showing in the bottom line here. And then the last thing on here in red was the travel, meals, and entertainment. And when we do all the add backs on that practice, if we were going to buy that, not only was it not making $54,000, it would really make us $173,000 on that. So we go back to that tax return that we're looking at, and it's very deceiving until you sit and analyze what all the things that were running through the practice that were benefiting the buyer, or benefiting the owner. And in this case, will benefit the buyer when he buys the practice. So, there's the auto expense, depreciation, amortization we added back, interest, the gifts, officer's comp, payroll taxes on both the officer and the associate, and then travel, meals, and entertainment. So a much different picture when you do these add backs to figure out what this practice was really making for that owner, or what it would make for you as the buyer in this case. So again, getting into the basics of this business tax return, the bottom line is the profit from a business tax return is not necessarily the true profit of the practice. And you're going to make sure that you have an accountant that specializes in this to analyze this for you, whether you're the buyer or owner of the practice. And we just wanted to give you just like a little snippet of some industry standards as we're doing this. Lab and supply costs should be about 16% of collections. Your employee wages and benefits should be about 22% of collections. Your facility costs, your rent, utilities should be about 6% of collections, and your profit should be about 40% of collections. So as you're looking at your own financials, you can take those percentages and look at yours and see how you compare to that. In this case, we have a couple examples here. In this one here, everything is red, meaning everything's too high. So in this case, the lab and supply costs are higher than the 16% we would expect. The labor is higher than we would expect. And the occupancy is a little bit higher than we expect. And of course, when all that happens, your bottom line is going to be lower than we would expect. And this next slide is just the opposite, where each of the items are at or under the ratios we would expect. So in this case, the lab and supplies are under the 16% we would expect. Labor is right at what we would expect. Occupancy is good. And here our profit is higher than the 40% that we would expect to see in this general practice. So this last couple slides is, I know, one of Paul's favorites. So this is where we have this $1 million practice that we like to talk about. And so if you're a buyer and you look at this and you look at the details about this, you say, this is a great practice because it's doing 1.3 million all these years. It's digital, 11 operatories, 6,000 square feet of space, 4 days a week, no evenings, no weekends, participates most PPOs, has 81 new patients a month. You're thinking this is a perfect practice, right? Well, as we sit down and analyze this, you're going to see that this practice is anything but. As we analyze this practice, and this was a real practice, the advertising on this practice was going up every year. And it was mostly because they had a consultant, and you'll see the consulting costs are going up every year. So what happened, they hired a consultant who says you got to advertise more. So they advertised more. Unfortunately, they were paying too much in wages. 50% of the 1.3 million was in wages. The rent was going down. Why was the rent going down? Rent was going down because they couldn't afford to pay their rent by that third year. Things were so bad. And when we looked at this particular owner, by that third year, worked the whole year to make about $11,000. So really worked for nothing. for that last year, work for nothing. So when you look at these financials, you look at these tax returns, it's really hard to do it as yourself. So you really want to have somebody that understands this, because if you go back to that slide, you, the buyer, thinking this is my practice, this is the one I want. But as you look at this slide that tells you what this practice really is, would you even buy that practice given with those issues? And if somebody's looking at this real close, they might ask, why did we not add back the marketing or the advertising and the consulting costs? Well, the reason we didn't, because we don't know how those expenses impacted getting to the 1.3 million. So not knowing that, we couldn't add those back. If we thought we could add those back and those revenues would stay the same, we would have added those back to the bottom line. So again, a summary, the profit may not be your true profit when you're looking at either the tax return or the profit and loss. Don't believe what you see on someone's tax return, just as we saw a perfect example in the last one. And for your practice, you want to make sure that you're getting your financials reviewed and sent to you on a monthly basis, and definitely hire a dental focused accountant for you as the buyer or you as the practice owner.
Perfect. Thanks so much, Bob. That was an awesome presentation. We got some feedback here from the group, and we're going to spend a little time answering a few questions. Let me just check here in our Zoom Q&A area. So if the previous owner, Bob, you can come on screen here with me. So if the previous owner has loans on their equipment, will that generally be transferred to the new buyer and thus bring over the depreciation amortization as well?
So what happens is that when you're buying a practice, you're buying the practice free and clear. So that seller needs to pay off all his loans, and you're going to get a practice free and clear. And when you buy that practice, your balance sheet is going to look different than the seller's balance sheet, because you're going to start off with a different set of assets and liabilities than he did. So your balance sheet will it will be completely different, have nothing to do with the seller's balance sheet.
All right, good question there. Thanks, Eric, from Facebook. I like this question. Hopefully he's still on. If nachos are brought into the office for staff, can they be deducted 100%? Entertainment nachos are not able to be written off at 50% anymore. Thanks, insert blank. I'm not sure 100% on vacation. I mean business trip nachos. So how does that fit in?
Well, so one, I don't want to claim to be a tax accountant because I'm not. So you really want to ask, when you have a tax question, Paul should be asking his accountant, his tax accountant, not me for that information, because I don't want to say something that your accountant might disagree with. So unfortunately, I can't answer that question.
I like that. Well, we have a lot of great accountants on the group who do that, so we'll get to them. I like that question. We have another question. Do you think it's more advantageous to buy a practice or build one from scratch? So Bob and I work side by side at United Dental Brokers of America, and we deal with this a lot. So I'll let Bob kind of take this. It's a transition broker question.
Well, I see both scenarios. I mean, there's certainly people that go out and start from scratch and become very successful. For me, as an accountant, I'm conservative. So unfortunately, I know those people that advise people to start. But for me, if I'm advising my son, I'd probably say no, because you can buy a practice and have instant cash flow and not have to stress on whether there's patients coming into your practice and how much you have to pay for the employees and when will you get to break even. And so just me as being an accountant, being conservative, for me, I would advise somebody not to do that. And that's not to say that you shouldn't start a practice. That's just me being a conservative accountant.
And it's a good question. I mean, I work with Jamie Amos. I know him well from my deal practices. They're amazing at what they do. I really would, if you're thinking of that, like I recommend with everything, whether it's on the podcast with Rob Montgomery, the Dental Amigos, be purposeful, be aware, be prepared, and look into these people who are helping people do this, because you will likely need geographic flexibility
to start up a practice. So if you want to be in San Francisco, Philadelphia, Washington, D.C., New York City, Austin, Texas, the easiest path a lot of times is to acquire an existing practice. If you think of patients like pizza, I love food, there's only so much pizza available in a certain area. Doesn't mean dentists are competing, it just means that you look at the patient to population ratios, and the tougher areas you're in, the tougher that is, like 1 to 1,000. That's why I practice in New Jersey. Someone came into the town and tried to start up a practice. It's challenging enough for the ones who are already in the town. So really good question there. Let's just take a couple more questions here. As we go along here, Q&A, I think I saw one more pop through here in the chat. Thanks so much, thanks so much. Okay, that's good. So my commentary here as we finish up with Bob is I really appreciate you doing this for us, Bob. And it just shows you what they do not teach us in dental school that they should. So dental students know math just like I do, probably better guys, you're smarter. And you could embrace this information whether you own a practice or not. I learned a lot sitting here. I've been a multi-practice owner for years because it's not fun. It's more fun to think about implant placement and veneers and things like that than it is to think about your P&L. I hope you realized how important it is to really wrap your arms around this, especially during the transition process, because things can be not what they seem on a P&L. So really do your due diligence, dig into things, make decisions in the best possible way. If you enjoyed See Like This, we're going to be doing the Dental Nacho Supreme in 2020. We're going to bring you 24 hours of live stream See just like that. All types of toppings, clinical, practice management, how to hire and fire, how to do high-level restorative dentistry, sleep apnea. So I have it up on the screen. Just reach out to us at supreme@dentalnachos.com. I love in-person CE. We're just about to do an enormous presentation in Philadelphia. Over 100 people are coming here in person. I love in person, but I also know that online CE live stream counts as live when you enter the code, just like you did here through CE Zoom. You're able to watch this on your couch. You're able to watch it over and over again. And I just think that's a great way to learn, do both. So thanks again, Bob. We appreciate it. And Dental Nachos crew, enjoy the rest of your day. We're going to get ready for our big event. If you have any other questions, you can drop them in the links, and we will do our best to answer them after this is over. Thanks, guys. I really hope you enjoyed understanding a P&L with Bob Septak. Just for watching, text dentist to 444-999, and you will get a free copy of the $1 Million Practice That Made No Profit. If you have any problem with the text, just email freenachos@dentalnachos.com, freenachos@dentalnachos.com, and ask for the free CE course on the $1 Million Practice That Made No Profit, and we'll be glad to send it to you. Check out dentalnachos.com for other exciting information.